Good morning, all. My name is David Gleeson. I'm the Managing Partner of RBK Chartered Accountants, and I welcome you all this morning to our Budget 2022 webinar in conjunction with the IB, the LR Rathdown Chamber and Athlone Chambers of Commerce. We have interesting speakers for you this morning, and now I'll introduce our speakers to you. First up will be Dermot Ryan. Dermot is Head of Business Banking with AIB, Business Centres Midlands Northeast. Next up is Oliver Mangan. Oliver is the Chief Economist with AIB. Oliver has worked as an economist in financial markets since 1990. He has been Chief Economist with AIB since 2012. Oliver specialises in macroeconomic forecasting and analysis of interest rate and currency markets. He also, for his sins, worked for the Australian Central Bank in Sydney. Next up is one of our own rising stars, Patrick Bannon. Patrick is a tax director with RBK. Patrick specialises primarily in corporate tax, advising a diverse portfolio of clients, including multinationals and owner-managed businesses across a broad range of sectors. Patrick has a particular expertise in advising on corporate restructuring, sale acquisition transactions, and related due diligence. He also advises and supports clients in the area of capital taxes, business succession, revenue interventions, and international tax matters. Our next speaker after Patrick will be Gerry McConville. Gerry is Vice President of Dún Laoghaire Chamber. Gerry will be speaking about issues facing businesses and the role of Chambers Ireland. Finally, but not least, Alan Shaw. Alan is President of the Athlone Chamber of Commerce. Alan will be chairing a question and answer session. If you have questions to raise, please use the question and answer facility there and submit them. We have some questions already submitted when people were registering. So Alan will chair the question and answer and wrap up the session. So without further ado, I'll hand now over to Dermot Ryan. Thank you very much.
Thank you, David. I think I'm on. Good morning, everybody. And you're all very welcome to this morning's event. On behalf of AIB, I'd just like to welcome you this morning. I think we'll all agree it still feels a little bit different to be hosting these events virtually. But hopefully we're getting back to face-to-face interaction very, very shortly. And no doubt this time next year, we'll be hosting this event in a more normal environment. AIB obviously are delighted to be associated with the event. Great to be working with David and the RBK team, with the Dún Laoghaire Chamber, and indeed as a board member, great to be working with Alan and my colleagues in Athlone Chamber. Really looking forward to this morning's speakers and listening to their views on yesterday's budget. Some of our Athlone Chamber members, colleagues will recall a webinar last week where we're very lucky and indeed privileged to have Minister Donoghue on the call. And he made a comment that the main thrust of this year's budget from where he sits was to ensure that the current strong rebound and recovery in the economy that we're all seeing is managed in a more sustainable manner. And I'm really interested to hear both Oliver and Patrick's take on whether the Minister has at least gone some way in achieving this ambition. So without further ado, I'll hand you over to my colleague, Oliver Mangan, AIB Chief Economist. Thank you very much.
Okay, good morning, everybody. Just share my screen with you here. I'm going to set the macro backdrop for the budget and have some say about the budget itself. Obviously, given the Minister owns 90% of or 70% of the bank, I'm not going to criticise him, but I think yesterday's budget was prudent enough. And in particular, what catches the eye when you look at it from a macroeconomic point of view is the rapid decline in the budget deficit, which wasn't on the cards not that long ago. So I'm going to set the macro backdrop. And as the Minister referenced, there is a very strong economic recovery underway. I get this to move. There we are. The IMF only published figures yesterday on the economic outlook, updated its forecast from earlier on in the summer. And there's not much change there. They're forecasting very strong growth this year and next year for the world economy as it recovers from a very deep recession in 2020 brought about by the pandemic. And you can see those growth rates there, 6, 6, 5. I mean, normally economies grow by 2 or 3%, but this is has been a very, very deep recession. and economies are recovering very, very quickly, reflecting the fact that rates are zero or negative, and there's a lot of fiscal supports in the system, and savings and this pent-up demand, etc. So we're seeing a rapid rebound in economic activity that should continue into 2022. Now, they don't forecast beyond that, but if we look at the central banks, etc., the expectation is that we'll get back to more normal growth rates from 2023 onwards. The recovery is bringing problems in terms of supply chain issues, labour shortages, and also marked pickup in inflation. So what I'm going to do is run through a number of charts just to give you the picture of that, focus on the Irish economy, and then have a look at the budget. So here we can see these are PMI indicators for manufacturing and services for the global economy. You can see they collapsed back in 2020, a very, very sharp rise this year to above their usual levels, signaling the very rapid growth in the economy. And anything above 50 there is very, very rapid growth. You can see in terms of labour market, I suppose the key release every month is the US employment report, which tells us where the payrolls are at, and they're recovering back to where they were pre-pandemic. But they've still got a bit to travel before we get there. But nonetheless, we expect that the Fed is confident enough, I think at this stage, to signal at its next meeting in a couple of weeks' time that it'll begin to roll back on its monetary stimulus, which means scaling back quantitative easing and then probably moving to rate increases later next year. However, as I said, what's interesting here in terms of the data is since between the middle of last year and the middle of this year, the data were coming in stronger than expected. The recovery in economic activity, it was not anticipated to be this strong. But what we've seen over the last 2 or 3 months, really since mid-year, is the data have come in below forecast, below expectations. There's no doubt that the bottlenecks in supply chains, shortage of inputs, shortage of raw materials, upward pressure on prices, as well as labour market shortages, are beginning to slow the pace of the recovery. Now, it doesn't mean the data are weak, but they're not as strong as had been anticipated. And there are headwinds there. We had data this week out of the Eurozone, big fall in industrial production, simply because, particularly in the auto sector, they can't get the inputs. A lot of firms are complaining about a lack of labour, shortage of workers. So that is beginning to slow the impact of the recovery. But nonetheless, the IMF came yesterday and still said, we expect the recovery to be strong, both this year and next year, but there are those headwinds out there at play. The strong recovery is bringing issues in terms of higher inflation. I'm starting with oil because there's a lot of focus on energy, an absolute huge surge in oil prices this year. A lot of that's an unwinding of the price declines last year. But having said that, oil now has gone above $80 a barrel. We haven't been there in about 8 years. Very big increase in gas prices. And that is driving, one of the factors driving up inflation rates. So, I mean, I think that's the charts say it all in terms of very, very sharp rise in inflation. And those charts go back 10 years. So very marked rise in inflation compared to what we used to in the past. An unwinding of price falls last year, an unwinding of VAT cuts, upward pressure on prices as businesses reopen, and a surge in demand, upward pressure on wages, all feeding through to that high rise in inflation. Now, the central banks are of the view that inflationary pressures will be temporary. I think they're hedging their bets now that they thought the inflation would fall back maybe early next year. That they now think it might be the latter stage of next year before we see supply chains rectified, improved, upward pressure on energy prices abate. But they're still confident that inflation will fall back to target, which is in around 2% within the next year or two. I think we focused here a lot in Ireland on rising house prices. This is a global phenomenon. I mean, house prices are surging everywhere. It's hard to believe that we had a very deep recession and house prices increased at such a rapid rate. You can see nearly 20% growth in house prices in the US, up to well over 10% in the UK. Ireland is approaching 10%. It reflects a shortage of supply, a build-up in household savings, and very low interest rates everywhere. So I think it's important to realise this is not just an Irish phenomenon in terms of upward pressure on the property market. So all of that has led to a change in interest rate expectations. The blue line is where markets thought interest rates would go last year for the next 2 or 3 years. And the answer to that was nowhere. The red line now shows markets expecting we will get rate increases over the course of next year and into 2023, starting with the UK early next year, moving on to the Fed in the latter stage of 2022. And even now, the ECB, as you can see there, the markets are beginning to think we could get rate increases there by the start of 2023. So that reflects the fact that you have a strong recovery, upward pressure on inflation, a lot of stimulus within the system, and the central banks begin to feel this recovery is sustained. We have exceptionally strong conditions. We need to start taking that back. In terms of Ireland, the indicators, we opened later than elsewhere, so we are a bit later to the party. Nonetheless, the indicators are very, very strong. You can see the PMIs there, higher than elsewhere, very, very strong on a historical basis. The recovery in consumer confidence, strong recovery in consumer spending, retail sales in the second quarter. That has extended into the third quarter. You can see the pickup in construction output, a very strong rebound in activity there since earlier on the year when the economy reopened. Overall domestic demand, this is the real domestic demand, the economy rebounding, and then really welcome a very, very sharp decline in the numbers on the PUP. The adjusted rate there includes the numbers on the PUP. It's falling back towards a more normalized rate at a very rapid pace. And that has been quicker than anticipated. The recovery this year, here and elsewhere, has been stronger than anticipated. And that's translated into those very strong tax figures we saw last weekend from the government, and they're the basis for yesterday's budget. And obviously, the upper pressure Irish CPI rate is no different than anywhere else. Most CPI, the US has gone above 5, the UK is going to go above 4, and we're certainly going to get a 4% inflation rate or higher before the end of the year. And as elsewhere, house prices picking up strongly. But having said that, the level of house building activity has held up better than expected. It's more, the recovery had leveled off in terms of the new housing supply in the last couple of years. I think the impact has been, rather than a fallback in house building activity, the uptrend we saw in terms of new house building stalled in 2020 and 2021. But as elsewhere, you can see the marked upward pressure on Irish house price inflation. That's to July. I mean, we could actually see 10% house price inflation here later on in the year on a year-on-year basis. So that's the backdrop. And in terms of the outlook, I mean, all the elements are in place now for strong growth to continue in the Irish economy. And that's the background for the budget here, recovering public finances on the back of a recovering economy. And you look at it, I mean, the vaccination rates are very, very high here, which is important going forward in terms of avoiding lockdowns and what have you, even if COVID remains with us over the next couple of years. We are an exporting nation. You know, the world economy is recovering strongly, good for our exports. Very strong pickup in house building activity underway, aided by government policy. Fiscal policy, and I'll talk about the budget in a second, will remain supportive of the economy going forward. Continuing low interest rates. Even if the ECB starts to hike, it's going to be at a very slow pace, and it's probably 15 to 18 months away before they begin to do that. Rates will remain low. Debt levels in the private sector are very, very low, and we have a massive build-up. That chart there on the right-hand side of the savings within the economy and the household sector. So there's a lot of pent-up demand there. There's a lot of savings which can come out. Now, there's no expectation that all those savings will be run down, but we'd see some run down of savings, fueling growth in consumer spending in particular in the next couple of years, and underpinning the housing market. So overall, strong growth for the economy. You know, the Department of Finance, Central Bank, others saying the economy can grow at around a 5% rate over the next couple of years. Very strong growth. So for the budget, I think it's important to think about the budget. I mean, yesterday we had a 1.5 billion package, right? But that is, you know, that's about 1% of the overall public finances. I mean, total government spending is around 90 billion. Tax receipts are around 70 billion, close enough to it. There's a borrowing in there, there's non-tax receipts. And yes, this package was around 1.5 billion, you know, a billion on savings, or sorry, a billion on spendings, 500 million in terms of income tax cuts, etc. I think it didn't get much attention, but the key actually publication in regard to public finances was this summer. It was the summer economic statement from the government, and it actually recalibrated what it was going to do around the public finances. The big focus was on eliminating the budget deficit earlier on in the year. It actually provided for increases in government spending, fiscal policy to remain supportive of the economy, a much greater focus on the national infrastructure plan, increases for capital spending, a focus on providing additional resources in terms of house building activity. And as a result, you know, the backdrop for the fiscal policy is it will remain supportive of the economy over the next number of years. Now, combined with that, we've had an absolute surge in tax receipts, particularly over the last 3 months, reflecting the rebound in economic activity. So tax receipts this year, believe it or not, are going to increase by over 15%, or 9 billion, taking them up to 66 billion. So to put that in context, the tax take was 59 billion only 2 years ago. Now, it's hard to believe we've come through a recession, we're starting to recover, and tax receipts are well above their pre-recession levels, their pre-COVID levels. And the result of that is, the government has provided massive fiscal support to the economy, business and households over the last couple of years. It's of the order of 50 billion, which is about 20% of national income. And that is as high as any other country. It's much higher than the Eurozone. It's and a bit above what we saw in the UK and the US, but that's been a massive fiscal support over the last couple of years. That's unwinding now. The tax receipts are recovering. The fiscal supports are beginning to fall off. They will be extended into next year, but a lot of them are temporary. And the budget deficit is falling at a much quicker pace than was anticipated. So the forecast this year was we'd have a budget deficit of 20 billion. That was reiterated in summer, in July. As a result of the strong recovery in the economy and the pickup in tax receipts, etc., they're forecasting a budget deficit of 13 billion for this year, falling to just above 8 billion next year. And then by 2023, the budget deficit is virtually eliminated. It goes to 1 billion, and we're moving into surpluses after that. So that restores the public finances to a very, very strong footing going forward. And it allows the government to, I suppose, permit government spending to grow in line with the economy. So what the government's provided for yesterday was taking away the temporary measures, and some of them were extended. The underlying growth, the non-COVID measures in terms of government spending, is going to grow by 5.5%. And then for the next number of years, 2023 onwards, it'll grow by around 5%. That will help sustain the recovery. It's not excessive growth. It shouldn't lead to overheating, but it's solid growth in government spending. And a lot of it is focused on capital spending. The increase in capital spending is 11 to 12% next year. And even along with that growth in spending, given the forecast for growth of the economy, the deficit continues to decline, tax receipts continue to grow, and we move into a surplus in the public finances. Now, it is true that we have borrowed a lot in the last couple of years, but interest rates are very, very low, and 10-year bond yields are zero. We can borrow 30-year money for less than 1%, and we're moving to a situation where we're only borrowing for capital purposes. So it's perfectly justified to borrow at these very low interest rates, particularly when you're directing a lot of those funds at capital investment and the economy is growing at a solid underlying rate. So the public finances are moving on to a much more stable footing at a much quicker pace than was anticipated even 3 months ago. We were looking at large budget deficits going out over the next number of years. The key, of course, is that the economy continues to recover, that growth is sustained, and that global upturn we're seeing in activity. As I said, the IMF just reiterated its forecast yesterday to continue. In terms of the budget, I think, again, a lot of the important things were not yesterday. A key thing was what happened last week in terms of the corporation tax rate, and Patrick would talk about this, but I mean, the maintenance of the 12.5% rate for the SME sector, crucial, rather than the rate up to 15%. That's a big bonus to get that derogation. The extension to the employment wage subsidy scheme to the end of April, it's going to be phased out, positive for business. The lower rate of VAT for the hospitality sector continues to the end of August next year. I know they would like it to go further. There may well be pressure to do that as next year progresses, depending on how the sector evolves. The minimum tax rate, again, it was signaled is going to go from 30 cents to 10.50. And a package of supports for the hospitality, travel, tourism, and live entertainment sectors announced for next year as well. And the commercial rates waiver will be extended until the end of the year for those sectors because they're only beginning to reopen at this stage. So overall, I mean, the budget yesterday had a lot of bits and pieces in that 1 billion stimulus package or spending package. I mean, obviously, a lot of it was around protecting or negating the increase in the cost of living because of higher energy prices, increase in social welfare benefits. But a lot of what happened was already decided in July. There's a 4.7 billion package announced then. The government decided we have the capacity to increase government spending more. We need to put money in terms of public infrastructure. So that's the positive backdrop for the economy here. Fiscal policy will remain supportive of growth over the next number of years. Rates may start to rise in 2023, but remain very, very low. So as I say, all the elements are falling into place for after a very difficult 18 months for the recovery we've seen as was commencing earlier on the year in April at a strong pace to continue out over the next number of years. Now, there are risks, and I'm watching the clock here. There are risks. I mean, COVID-19 hasn't gone away. It's proven more persistent than people anticipated. I'm particularly concerned with the low vaccination rates in developing economies. I mean, there's always the risk of new variants that are vaccine resistant. But we have very, very, very high vaccination rates here, and that is positive in terms of keeping the economy reopened. I would say it looks like that there won't be much long-term damage done to the economy here or elsewhere by what happened over the last 18 months, the pandemic, but we won't really know that until all those supports are withdrawn, in terms of the employment wage subsidy, the supports for firms, the supports that are provided by households. We'll see over the next 3 to 6 to 9 months how many businesses have been really badly hurt and can't continue in operation. But just looking at our own book here in terms of lending, etc., I mean, there were breaks given over the last year in particular, like the vast majority, into the 90% are back repaying debt on normal basis. No sign of stress within the books. So overall, the expectations that the scarring effects will be limited, but you can't really be fully confident of that until the supports are withdrawn. We are concerned about the disruption to supply chains and labour market shortages. I mean, there could be long-term implications here or long-term effects in terms of what we call structural effects, in terms of the willingness of people to work, pay public transport. There are signs that some workers are reluctant to go back into the workforce while COVID is still there, and may feel, that the risks are too high. There's also supply chain disruptions. I think that'll take longer to resolve them, that central banks are anticipating. There's no doubt businesses are looking at their models and our long supply chains, relying heavily on, let's say, supplies or inputs or goods from China. Is that really the way you should be running your business going forward? Should you distribute the risk there, have close supply chains? And linked to that is that the rise in inflation could prove more persistent. If that's the case, central banks will not hold back. They will increase rates quite aggressively over the next couple of years, and that will be not good news for the recovery. So it's important, I think, that inflation actually, that it starts to fall back over the course of next year. And I mean, there's plenty of oil and gas out there, but it's going to be a tight market over the winter. But we would expect to see a downward trend emerge in energy prices, say, from next spring onwards. I think the principal risk in terms of inflation is actually wage inflation. If that labour market remains really, really tight, I think we'll eventually support the supply chains. The energy market will see increased supplies over time. The labour market's where the main risk is, and that ties into a risk of higher rates if we're into a sort of wage price inflation spiral. Financial markets are at very elevated levels. Credit spreads are very tight, stock markets are very high, house prices are very high. A lot of that's predicated on continuing low interest rates. The markets can handle some increase in interest rates, but aggressive monetary tightening would, I think, kick the legs from under the table in financial markets. It's a risk there. And then China, it's been a major driver of global growth over the last 4 decades. I think that's coming to an end. I mean, there's internal difficulties in the financial sector, there's signs of imbalances. And I think people are going to have a long, hard look of solely relying on China as a source for their supply chain going forward. It still will grow strongly, but we may be looking to pass the baton to other emerging economies, India, Indonesia, those sorts of large population bases there as a source of global growth going forward. So the prospects are good, but risks remain. And I think the budget yesterday was no great surprises. Prudent, will remain supportive of growth going forward. We will not see a rerun of the fiscal contraction or the fiscal rectitude that we saw back in 2008, 2009, all the way to 2012. The public finances have recovered very, very quickly. The key thing here is the tax base has remained intact. The tax take was 59 billion back in 2019, 66 billion this year, heading for 70 billion next year. The late Brian Lenihan saw a third of the tax base evaporate in front of him in 2008 and 2009. That was a completely different scenario. So this is certainly different this time. So 20 minutes I was given, that's it. I think a positive outlook, but be conscious of the risks, particularly in the labour market, supply chains and rising inflation. Well, I hand over to Patrick there.
Perfect. Thank you very much, Oliver, for your very comprehensive overview. I think it really does set the backdrop in terms of the economic position and what was feeding into budget 2022, and indeed the uncertainties and what's facing us into the budgets into the future. So the focus of my own presentation will really be to go through the specific details of the taxation measures which were announced by Minister Donoghue in his speech yesterday. There's, as is the case with all matters relating to tax, there's quite a good bit of detail to analyse and digest in terms of the announcement of any specific tax measures, but hopefully what you'll come away with today is a good understanding of a summary and an overview of what those key measures were. Just to quote the Minister initially, just in terms of the overview on the budget. I think Dermot touched on some of these points earlier on around the government's focus on sustainability of the economic recovery. So really what the budget was set out to do was to meet the twin goals of investing in future while meeting the needs of today, while putting the public finances on a sustainable path. So that's very indicative of policy, and Oliver would have touched on a good deal of that earlier in terms of the government's fiscal agenda and policy going forward. I suppose if you take a step back from the detail of the announcements yesterday and you actually just look, it gets your mind thinking about the year that has just gone before us in terms of what we were facing in budget 2021 versus what actually was the backdrop to budget 2022 in the current year. So what you're looking at really, I suppose, at the time in budget 2021, we were facing into a significant response, obviously, to a once-in-a-century global pandemic, record levels of current spending, significant support required for the labour market and businesses, and obviously the additional uncertainty of Brexit. As Oliver summarised very, very well, obviously, we're now going through a period of an economic rebound and recovery. There's a significant, the tax receipts have their tax receipts remain significant. They've held up. We actually are facing other challenges around labour market shortages, and indeed there's a new backdrop in terms of international uncertainty around rising energy prices, supply chain issues, the shortage of raw materials, and other factors, including global inflation. So it is quite a difference that a year has made. To outline some of the key factors underpinning the budget, a big focus, and again, I go through most of the detail of these when we're working through each of the individual elements. An exit strategy out of the pandemic supports is very important. So what certainty would there be for business in particular in terms of an easing out of this very significant supports that were there throughout the pandemic? The managing that post-pandemic economic rebound and in the backdrop of all the various global economic pressures. Obviously, the lead up, the large, I suppose the main focus and the main backdrop in terms of the global tax reform. There was a lot of lead up in the lead up to the budget in relation to that, and I'll go through some of the detail of that later. We obviously do continue to have the domestic pressures, particularly in the housing sector, and the climate change and promoting the green economy remains obviously a key focus of any government policy, and the Minister alluded as much in his speech yesterday in terms of the importance of addressing the climate change agenda. So when in analysing the measures, we sort of split it out into various categories just to kind of put a bit of a framework in terms of setting out each of the individual measures. So the cost of living, so addressing those issues in terms of maintaining individuals' cost of living, the measures around the housing sector, the measures in relation to business, and then the final measures that were set out in terms of climate and any other taxation measures which are worthy of note. So just in relation to the cost of living, the government did set aside roughly £500 million in terms of tax measures available to support changes to income tax. Is largely reflected in two key changes to income tax. There was a increase to the standard rate band, so the rate at which you pay 20% tax, that increased by €1,500. There was also an across the board increase on all the key tax credits, so the personal tax credit, the employee tax credit, and the earned income credit. They all respectively increased by €50 each, taking them up to €1,700. The USC also saw some modest changes in relation to the expansion of the 2% band on the USC. This was to take account of the increase in the minimum wage. The minimum wage increased from $10.20 to $10.50. So the USC, the 2% band increase accommodates for that increase. There was also, Minister also announced that the reduced rate, which has been there for medical card holders and those over 70 years of age earning less than 60,000, that will be maintained, meaning that they'll pay at the 0.5% rate for the first 12,000 of their income, and then the capped at 2% on the balance of their income thereafter. We just kind of ran an overall summary just in terms of a couple of scenarios just to demonstrate what the impact of the income tax changes might be and what the net impact in terms of your overall net take home pay. You'd see there broadly on average you're talking about roughly in or around a €500 net increase in your take-home pay as a result of the standard rate banding tax credit changes, depending on your circumstances. And I suppose the percentage impact as to how that impacts at different levels is demonstrating, I suppose, the progressive nature of the changes, and that it does benefit those on a net percentage basis. It does benefit those at the lower incomes. Another aspect of their approach towards addressing cost of living was recognizing the changing work environment. Obviously, there's been a huge shift in working patterns. I think something in the order of almost a quarter of individuals now working on a remote basis. So this was seen as, I suppose, anticipation that we would see some significant announcements in this area, rather modest in terms of the changes. So all that really came through, for anyone who's familiar, an individual can claim an income tax deduction in relation to the vouched cost of expenses that they do incur in respect of time they spend remote working. That was 10% for heat and electricity. It was concessionally 30% for broadband during the pandemic. That's now been increased up to 30%, which is unlikely to have much of an impact in terms of the overall position. There probably was, just in practice from our own perspective, there probably was a couple of areas which effectively remain outstanding and issues that we've seen probably should have been considered as part of the overall response to remote working, in the context of understanding an individual's normal place of work and how that interacts with allowable administration of travel and subsistence, and then whether or not there's other incentives there actually to encourage employers to promote a remote working environment. So something in the line of accelerated capital allowances for home office equipment could have been something that the government could have looked at in terms of further enhancing those measures. I suppose, whilst on the topic of cost of living, and albeit we reckon not specifically tax measures, Minister McGrath obviously did announce a wide spending measures across a number of different departments in terms of those type of measures that would have, I suppose, a direct impact on individuals and their cost of living. Just summarise some of the key changes there. So the National Childcare Scheme, the universal subsidy that's payable under that scheme now has been extended out to those up to 15 years. There's a youth travel card introduced for the 19 to 23-year-olds to provide discount on travel. There's that well publicised and well flagged in advance €5 per week across the various weekly payments, job seekers, pension and fuel allowances. And then there's also an additional 2 weeks parental leave to extend that out to the current provisions out to 7 weeks. And the free GP care has now extended beyond those up to 5 years and to include those ages 6 and 7. The housing is, of course, and again, the Minister in his announcements yesterday acknowledged that this is the core issue facing the government and has been for quite some time and will remain to be the case. Obviously, there's a significant spending package announced to support ongoing supply of housing by the state. In terms of the taxation measures, the cornerstone or the key measure that was announced yesterday was this introduction of a zoned land tax. So effectively it replace, if some people are familiar, there is a current vacant site levy that is administered by local authorities. This zoned tax, when it is introduced, will replace that levy, and its key objective really is to try and drive the supply of residential accommodation. So government are very keen for us to understand it's not seen as a tax raising measure, but more of a measure designed at encouraging supply. It will apply at a rate, is indicated that the rate will initially be 3% of the market value of any land being zoned residential land or land that's zoned as mixed use, which has been serviced but has not yet been developed for housing. Now, the Minister has indicated that 3% rate is open to review at a later stage, so there may be changes to that. There's quite a significant lead-in time to the introduction of this tax, so we're looking at 2 years out from 2022 in cases where land was zoned prior to that date, a 3-year lead-in period for land zoned after that date. So again, it is allowing that time, I suppose, to see will this measure actually encourage supply and adjustment in that context. There will be certain exemptions within that. They'll be published and outlined as part of the finance bill in the detail to follow in the coming weeks. And local authorities will be providing or involved in the detail and the administration in terms of specific maps outlining the detail of how that levy will be charged. The Help to Buy scheme, that was initially due to obviously the fundamental support to support first-time buyers in in entering the property market. That was initially due to end by the end of this year. The main announcement yesterday is that is extended for a further year out to 2022. The relief will stay exactly as it is in terms of the parameters of the relief and the various caps set out there, all the way up to the lesser of 10% of the purchase price, 30,000, or linked to your income tax and dirt paid in the last 4 years. There is actually undergoing a detailed review in relation to the Help to Buy scheme. There's a number of various policy objectives that have been set out in terms of framing that review, and that review is to be carried out in 2022, obviously ahead of to see likely further announcements in the budget next year. The other area in terms of, I suppose, to assist landlords, and again, in terms of supporting supply of residential into the market, was that the pre-letting expenses for landlords has now been extended out by a further 3 years. So if you've incurred expenditure within 12 months prior to a letting, you will get a deduction of that against your rents, capped up to 5k per each vacant property. I'm not going to go through the detail of this particular side, but this is just a reminder to everyone in terms of this isn't a budget measure that was announced yesterday, but there is a 10% stamp duty rate that applies in terms of bulk purchase, so 10 or more residential houses purchased in bulk. Again, it was another measure to try and encourage or discourage this type of bulk purchase of properties and increase supply into first-time buyers. So again, just to be conscious of that particular rate, that's just a reminder on that. In terms of the various business measures, moving on to that aspect of it, Oliver again would have mentioned it earlier in terms of the various supports and the measures that were introduced. Obviously, the core support measure at the moment is the employment wage subsidy scheme, which is followed on from the temporary wage subsidy scheme, which was initially there at the outset of the pandemic. The welcome news for businesses is that is extended out until the 30th of April 2022. It will take on a graduated form between now and then. So for businesses who are currently within EWSS, there'll be no changes in relation to October, November 2021 and the rates to be paid. The criteria remains the same. The businesses then who are actually still part of the scheme by the end of this year, they will get to continue on in the scheme right through to April next year, and there will be a graduated rate structure in terms of the rates that will be payable under the scheme, falling back to ultimate VAT rate of €100 before the support ends. There will be, just to be mindful, that in the reduced rate of employers PRSI, so you could have qualifying employments were only liable at 0.5% that won't apply to employers who are part of the scheme for the months of March and April next year. So just be conscious in terms of planning ahead for that. There is a business resumption support scheme. Just again, it was announced earlier in the summer, just so people are aware that it's there. It's an additional scheme that's been announced to support those who continue to suffer an ongoing impact from the pandemic. Obviously, it's quite targeted in that it deals with businesses that have suffered at least 75% reduction in turnover. The applications for that are open to the end of November. So if there is impacted businesses, certainly something that they should be considering and looking into at this current juncture. And that 9% VAT rate, so it would have been made clear prior to the budget, but that's been extended out to the end of 2022. At the moment, Oliver mentioned as well, but despite the fact that there's likely to be significant pressure in due course to try and expand that, to look at an extension on that rate, is unlikely at the moment that there isn't an anticipated extension beyond the end of that period. But again, it's something to keep an eye on as the recovery progresses. Another, outside of, I suppose, those direct supports, the employment incentive scheme. This is a scheme that again can help SMEs and businesses in terms of, particularly in the startup phases, in terms of attracting inbound investment from investors by offering a relief of up to 40% of the investment, subject to various caps and conditions. The scheme of itself hasn't really reached its full potential, and the minister has admitted as much in terms of the detail of his speech yesterday. So what the budget has announced, and the details again will follow in the finance bill, is to try and look at a number of different enhancements that will actually look towards attracting more investors into the scheme and actually ease administration for companies who are part of that scheme, obviously with the overall goal of trying to improve the effectiveness and the uptake of the scheme, because it probably does have, as a scheme, it does have quite a good potential to support businesses and be successful. So hopefully those measures will go some way to encouraging that. The the government also announced an innovation equity fund. So this was initially flagged in budget 2021, where there was a commitment made through the Ireland Strategic Investment Fund to allocate 30 million to an innovation equity fund, which would make funds available to seed stage or early stage funding for Irish SMEs. There's been a further commitment of 60 million euro to those via Enterprise Ireland and the European Investment Funds, that will launch in early 2022. There's currently a memorandum of understanding to be agreed between the parties in terms of how to administer that fund. But again, one to look at in terms of supports for businesses. The final key measure really was around startup companies, and there was an existing provision there, people may be familiar with it, for startup companies, whereby you would actually be fully relieved from tax on your profits up for companies earning with profits under 320,000 euro. That was due. That was now been extended out beyond the end of this year for a further 5 years, and will be available for new businesses coming within the remit of the scheme over that 5-year period. So again, that's a welcome addition. In the areas of sort of R&D and innovation, there hasn't been anything significant on R&D, but innovation, particularly, the big ticket item was the introduction of this digital gaming tax credit. So it was initially committed in budget 2021. The detail has come through now in budget 2022. So effectively, it's an R&D style regime, in that it's a credit available against your corporation tax. The credit's quite generous in terms of a 32% credit being available. There's caps on the various expenditure. The whole concept of this is to tap into some of that significant global market. Ireland seems to be lagging behind in terms of capitalising on that significant, I think it's up to 100 billion the global gaming market is worth, and it's hoped that this initiative will actually look to capture some of that through providing relief for expenditure on design, production and testing of various games. It is subject to an EU state aid approval and commencement order, so it will take some time for that to come through. Just very quickly on farming, just to take you through the stock reliefs and the young trained farmers reliefs. They've all been extended, some of them out to 2022 because they're tied to state aid rules, so they can't go beyond that date. The general stock relief provision's gone out to 2024, and one of the few increases was just in relation to the VAT, and just to or a few changes in terms of reduction of a benefit really for farmers, was just the flat rate addition is being scaled back from 5.6% to 5.5% from the start of next year. And as Oliver had touched on, the global tax reform agenda, that was the huge backdrop to the budget this year. There's obviously a significant amount of resources and work gone in, particularly at government levels, at OECD and EU level, over the last number of months in terms of negotiating our agreement to take part in this tax global reform deal. The headline to take away from it is that the rate for multinationals is to increase. This wasn't, I suppose, unexpected. It was always likely that there would be some increase or departure away from our 12.5% rate. And the assurances that we did get was around ensuring that rate would be up to that 15% rate, and obviously the key carve out is having the domestic corporate taxpayers, so our indigenous and domestic sector will be able to retain the 12.5%. That will apply to all companies with global consolidated revenues of €750 or less. So that's obviously a welcome derogation. It is a significant milestone. The key will be how will this impact on the future in terms of attraction of multinational investment. Look, 15% is still very competitive, so it shouldn't really have a huge impact, but the focus will be how do we actually frame our policies in terms of promoting that ongoing investment and continue to attract foreign direct investment, be that through innovation, R&D, or indeed measures to retain and attract talent. This is a short side. I'm going to go too much detail. I'm just conscious of time at the moment. Just in terms of setting out, I suppose it wasn't all about the 12.5% rate, just being conscious that there is a myriad of different rates in terms of corporate tax. You can have an effective rate of 0%, obviously, for the startups, as I mentioned earlier. If you're availing of R&D tax credits, can significantly reduce your tax rate. And then there is that lower rate available for any of those who are part of who have income under the Knowledge Development Box scheme, and indeed increased rates for passive taxpayers. The the other couple of measures, again, I won't spend too much time in the detail of these slides, but just to make people aware of it, we were under obligations under EU directive to transpose certain rules around interest limitation and anti-hybrid rules. The interest limitation rule is just putting a cap on how much interest can be deductible as an expense. There is de minimis rules, which means net deductions under 3 million won't be captured by this. So again, the detail is likely to not impact on very many businesses, but just want to be conscious of. And the anti-hybrid rules as well, focused on avoiding these hybrid mismatches, which will result in double non-taxation. There's measures to be brought through in relation to that. On the climate and environmental agenda, I suppose people were probably anticipating a much broader or more significant radical changes here. There hasn't been anything overly unexpected or new in what the government has set out. The accelerated capital allowance regime, which you'll be familiar with, that's been extended just in relation to certain types of renewable gas vehicles and hydrogen powered vehicles out to the end of 2024. And there's been a minor amendment to kind of ensure it only operates for those equipment that are not fueled by fossil fuels. The key cornerstone of the whole environmental or the environmental response at the moment is the graduated increases in carbon tax right through to 2023. So again, the commitment was followed through. The 750 per tonne came through in relation to petrol and diesel overnight, which I think results in about maybe a 2 to 2.5 cent increase in prices. May 2022 we'll see that coming through for home heating oil. Just on the tobacco piece, there was a 50-cent increase as there was last year in relation to cigarettes, and graduated increases across other areas. The VRT that went through a radical piece last year, there's been some expansion on the rates in some of the higher bands, just to be aware of. They've retained the relief on the battery operated vehicles, and there's a small nod to those who generate their own electricity and sell it back to the grid. They get a small income tax exemption on €200 of their income. BIK on electric vehicles, that has been extended out to 2025, but there will actually be a tapering effect to start in 2023. So at the moment, you can acquire an electric vehicle exempt from BIK up to 50,000, and then partially beyond that point, that 50,000 value will slowly taper away, 35,000 in 2023, tapering back to 10,000 by 2025. Some other tax measures. Unfortunately, nothing to really say here on the capital taxes. Many people had hoped for some changes. There's been no changes to any rates, no changes to any reliefs. The debt warehousing scheme, just be familiar with that. That didn't initially extend to proprietary directors in terms of their income tax debts. The finance bill will have some measures in relation to allowing for warehousing of certain debts where they're liable to Schedule E as part of their employment income. And just to bear in mind for your income tax returns, just a couple of the reliefs that rolled over from last year, just in terms of the tax relief on losses for self-employed and the step out from income averaging for farmers, just in the lead up to preparing for your income tax filings, just to bear those in mind. So what's next? The big item on the agenda in terms of budgetary planning next is really the launch of the Commission on Taxation and Welfare. They've been charged with the task of kind of reviewing the taxation and welfare systems and seeing how best that can support the economy and in the context of promoting increased prosperity and delivering efficient public services. That consultation process will start from in the next couple of weeks. There'll be a consultation process, and then it's expected the announcements will be in summer of next year, which will be in good time ahead of budgetary measures for 2023. So then I suppose, conscious again of my 20 minutes, so I'll keep it nice and brief in terms of conclusion. So where did budget 2022 sit? Look, in terms of cost of living, there was a bit there for everyone. It has gone, I suppose, people would welcome the changes in income tax. On the housing side, there has been obviously the introduction of the zone land tax. People will hope that will go some way to boosting supply. I suppose the main moves was on the business side, and it was very welcome to see the improvements to the EII and also the continuation of the EWSS scheme. Around climate action, I suppose the agenda there will really be to see will there be any further radical changes beyond carbon tax in future budgets, and really it will be that Commission on Taxation and Welfare will be the perfect backdrop, and will probably set the stage for the key taxation measures that we will be looking ahead to in future years. So with my time up, I think I will just leave it at that, and I hope I'm not gone too far. too far beyond, but thanks very much. And I'll hand over to Gerry McConville now. Gerry is the Vice President of the Dún Laoghaire Down Chamber. Thank you.
Okay. Thanks very much, Patrick. I'll keep mine very brief. I know there's a lot of questions in, so we want to make as much time for that as possible. There's probably two areas that I'd just like to comment on. One is just in terms of the challenges that our businesses, our members in the chambers are experiencing, and the other one then is maybe just to say a few words on what supports and what initiatives the chambers are taking. Certainly, you know, from what I can see, the focus is very much on getting back to business and taking advantage of the rebound in the economy. We can definitely see that there's been an increase in demand. In my own day job, I'm the CEO of Capital Credit Union, and we can see an increase in the demand for SME loans, both through normal lending and through the COVID guarantee scheme. But in terms of the budget, I suppose we were keen to see what supports would be there for businesses that are coping with the current challenges. And I'm glad to see that some of the COVID supports are continuing for a period. The previous speakers have also spoken about some of the challenges that we're facing, and certainly shortage of staff is one, supply issues is another one, and the whole rising costs is another one as well. So, you know, those pressures are coming through in terms of high, for staff anyway, you know, in terms of high rents, childcare costs, working from home and stuff like that. So I think most of that has been covered. In terms of the initiatives that Chambers Ireland has been taking all through the pandemic, we've been continuing with the B2B networking, and I'm delighted to say that that is now resuming on a physical basis in a lot of the chambers, and something that a lot of businesses have been crying out for. We in DLR Chamber, we recently held a golf event, and it was like everybody was like children attending it. They were so delighted to get out and about and to be mixing with each other. The climate has been mentioned by a number of the speakers there earlier, and certainly Chambers Ireland has developed a sustainable development goals toolkit for businesses, and also climate ready supports for businesses to develop practical skills and knowledge to adapt to the climate challenges. And Chambers Ireland has partnered with SkillNets Ireland on the climate ready. In DLR Chamber, we've got the Lean programme. So it's developed in partnership with the local enterprise offices. And it's a training programme to equip businesses with knowledge and skills to undertake Lean projects. And Lean, of course, tries to stamp out waste and develop continual improvements in processes. So they're just some of the things that the chambers are working on in terms of supporting their members. But look, I'm conscious that we are very tight on time, so I'm going to hand over to Alan Shaw, who is chairing the Q&A session. So thanks, Alan.
Thanks very much, Gerry. So just conscious of time now, we're not far from the end, but we have time to take a number of questions. And thanks to everybody that submitted questions through the Q&A box. The first question I might direct maybe Oliver Mangan, Chief Economist of AIB, and it relates to the issue of housing. It's probably one of the largest issues that of our time that's confronting our economy and the government these. And I suppose if you look at the measures that have been introduced in the budget, the government is adopting more of a stick rather than a carrot approach. What's your views on it, Oliver, in terms of has the government gone far enough to make a change in terms of the supply on the housing side?
Well, as I referenced earlier, I mean, a lot of the key decisions were taken in the summer when additional resources were outlined. So there wasn't much new yesterday. As Patrick indicated there, that side levy is going to take effect in 2 years' time. I think we watched the data very closely, and what we're seeing is since the sector reopened in April, an absolute surge in what we call commencements or housing starts, which is pointing to a marked increase in supply that we've been waiting for some time. And you know, the much talked about figure of 30,000 new homes a year. we were running at, if you go back to earlier on in the year, the number of new builds commencing was of the order of 17,000. That actually has picked up to 30,000 in the space of 4 or 5 months and is increasing. So I think the measures that have been put in place are certainly giving builders and developers confidence to bring new supply onto the market. I think one of the reasons, probably the most important thing, is the backdrop here in terms of the economy continues to grow strongly. People are returning to work, incomes are supported, and that people have the confidence to go out and look to buy homes, and builders have the confidence on the economic outlook to go and build those houses. So it's pretty encouraging to see the increase in new supply. We saw it in the planning permissions over the last couple of years, but it's really starting to come through in terms of new commencements. And that's a very positive sign. So I think, as I said, in relation to the budget, it gets a lot of focus. It's a big political event, but actually a lot of the groundwork is laid before this and was laid earlier on the year in terms of trying to kickstart the construction sector, the house building sector. And the good news is it's beginning to come through in the data.
Hey, that's great, Oliver. Thanks for that. Patrick Fannon, Tax Director, RBK. I'll go to you next, maybe. In the whole area of directors looking to buy electric cars in their companies, either for themselves or for maybe sales staff or sales team, and the question of BIK and around that. Was there any measures in the budget, I suppose, in terms of moving towards the green economy and incentivizing the use of electric cars? Was there any measures in the budget that would impact this throughout 2022?
Yeah, and I suppose the key piece there is an existing, so to promote purchase of electric vehicles, there is an existing BIK exemption that's there that up to 50,000 of open market value. So the key measure, as I mentioned earlier, was to see an extension of that out to 2025, but there will be a specific tapering of that exemption over a period of time. So I suppose it's acknowledging a continued a continuation of encouraging purchase and investment in electric vehicles by offering that 0% BIK exemption. But obviously there will be a transition away at some point in terms of tapering away the impact of that relief. It is allowed for 50k, as I said now, but that will taper back gradually to 2025. But yeah, there is welcome news in terms of extending that measure, at least in part.
Okay, thanks very much, Patrick. Dermot Ryan, Head of Business Bank in AIB and Athlone. Dermot, just in relation to the issue of, I suppose you may have, obviously there has been a build-up of savings by many of your customers and in general indeed over the past while. And is it expected that will suppress somewhat this demand for lending going forward, or what view are you taking on the ground in terms of from the AIB's perspective?
No, Alan, we're seeing more than what was outlined earlier. We've seen a lot of demand, particularly from our SME customers in various sectors. And in terms of build-up of deposits, we wouldn't see that as a major impact on our ability to get lending out into the system. So we're seeing a lot of asks, and obviously we're looking after our customers, and we wouldn't see any impact on that, to be quite honest.
Okay. One final question then, maybe for you, Patrick, just in relation to redundancies. Some businesses are obviously reviewing their staff levels and so on, and you know, some companies will be coming under pressure maybe in the first quarter next year as the reliefs are tapered. Is there any sign of any additional redundancy supports for employers from this budget?
Nothing on the specifically in relation to the taxation side around those redundancy type measures. Obviously, the relief is there, as you said, in terms of EWSS, so that at least there's certainty around having that level of support out to the end of April next year, but nothing specific on that side, on the taxation side.
Okay. Okay, and maybe just one final one then for Gerry McConville, Dunleary Rathdown Chamber of Commerce. Gerry, just in terms of your members, and I was looking at some of the members in Dunleary Rathdown Chamber. You have a fine array of members from a whole plethora of different areas of business. And what's kind of the view on the ground from this budget in terms of positivity, or did the government go far enough to support businesses in key areas?
They can always go further. So, but I suppose, the continuation of the COVID supports is very welcome, and I think it has made a difference. One of the things we've noticed in DLR is the tourism, the pickup in tourism within the county has been very, very welcome. To see the low rate of VAT continuing there, I think is also very welcome. I think some of the other measures are probably going to take a bit of time to come through and are maybe just tinkering at the edges. So, I think some of those will take a bit of time to come through. But look, we welcome the continuation of the supports that are there.
Okay, Gerry, well, look, we'll leave the final word with you. Thanks very much indeed. I just want to thank all of our speakers this morning. So I want to thank Dermot Ryan and Oliver Mangan from AIB. I want to thank David Gleeson and Patrick Fannon, Tax Director from RBK. Gerry McConville, Vice President of Dunleary Township, Member of Commerce. I want to thank Deirdre McElroy for organising in the background, organising the webinar and organising us in terms of our links and so on and so forth. So thanks very much, Deirdre, for that. And I want to thank you, all of our participants, for registering this morning's event. There will be answers provided to all your questions that we may not have gotten to this morning, but they will be responded to shortly, as well as a copy of the slides submitted to all of you in the coming hours. So thanks again, everybody, for participating, and until next year, take care. Bye-bye.
Thank you.